There is a ton of information about investing out there. So many opinions out there floating around. More information is available than has ever been before. There's a lot of misinformation and even a lot of straight up lies that are trying to lead you astray. That's why it's very important to know what's a myth about investing and saving money and what are things that are true. Knowing the difference between those two will allow you to become wealthy. So today, I want to talk about the 10 common myths about investing and how they can hurt you in your financial journey. My name is Artem Chuprin. I love talking about investing, money, and helping you get a better financial future today. The first myth that we're going to cover is investing is super complicated. In fact, it's so complicated that you need to hire a professional and pay him a lot of money to help you make some money. There is a lot of information out there about what kind of account do you need. Do you want a Roth IRA? Do you want a traditional IRA? Do you want a normal brokerage account? Do you want a tax advantage account? Between opening up an account, figuring out which investment is better, what kind of environment we're in, is it a high inflation, low inflation? Are we thinking that it's a recessionary environment? All these kind of terms start to get thrown at you and you don't know what the heck to do next. There's a lot of information out there that we may not know. We didn't learn it in school, we didn't learn it in college, and the financial industry loves that. Because they try and swoop in and tell you, hey, we know how to do this. We know how to manage your money. All you do is just pay us a little bit of a fee and we'll take care of your money for you. The biggest harm that this myth presents is the fact that all you have to do is open an account and invest in an index fund. Just doing that, you're gonna automatically make more money than 95% of professionals. The financial industry will definitely not try and tell you that fact. The biggest harm of this myth is the financial industry will make things seem super complicated and telling you you can't possibly manage your money. It takes professionals to do it. All they are going to tell you to do is just simply hand your money over to them, let them manage it for a small fee of just 1%. To put it in perspective, this is what that 1% will cost you. If you put in $100 every paycheck from the time that you're 20 to the time that you're 60, you're gonna make $1,114,000 on that amount of money. That's an awesome return. But let's say you decide to have a wealth management firm manage your money and it's gonna cost you just 1%. That 1% will cause you to have a return of roughly $846,000. That is $267,000 less of your return. That 1% that they're gonna manage, that very small amount, is $267,000. So the easiest way to keep it simple, there's an acronym called KISS, keep it simple, stupid. I tell that myself all the time. The best way to keep things simple is if you buy into a index fund that is low cost and you do it consistently, no market timing, just keep doing that over the course of your working career, you will become wealthy. Most of you guys already have a 401k that you automatically signed up through for your work. All you have to do is find out where that money is invested in, what are your options, just choose one of those, and that's it. You don't have to manage your money, you don't have to do market timing, you don't have to know all the fancy jargon, all the fancy terms. Just consistently keep money invested, and that will outperform 95% of professionals. You will beat them at their own game. The second myth is you need a lot of money to invest in order to make money in the stock market. So that myth keeps a lot of people from actually investing more or investing altogether. They never start investing. Quite simply put, if you put $100 into an index fund, every paycheck, twice a month, over the course of your working career, you will have more than $1 million when you retire. That's without a match. If you have a match through your work for 401k and you put in $100 and they put in $100, you're gonna have $2.2 million when you retire. So that measly $100 every paycheck, that's gonna grow into some crazy amount that you can't even imagine. So start small, but start. Don't think that once I have a bigger amount, then I can invest it. Start investing today, no matter how small you have it, and just consistently keep doing that. The third common myth is that investing is super risky, that the market can lose all your money. It is true that investing can go up and down, but the fact that you have money sitting in a bank account right now, you're guaranteed to lose money. Now, if you're gonna try and invest for the next year thinking you're going to make a lot of money, or you're going to try and time the market in and out to try and make a quick buck, or maybe go into options or calls or something crazy like that, then that is very risky. The fact that your money sits in a bank account right now, you're guaranteed to lose 3 to 4% every year. This year, we lost 7% due to inflation. Now you can say, but Artie, stocks have crashed like crazy in the past. What if we have a massive crash just ahead of us? What if we do? The market has crashed in 2000, in 2008, and what happened to the stock market since then? It is much higher than where it was. As long as you continually invest in the stock market without panic selling, without overreacting to the drops, you know what happens after the drops in the stock market? It goes right back up. It can take a year, it could take 2 years, but the market will go higher. So thinking it's too risky to put your money and make it grow over the long term, you're actually choosing a guaranteed risk of losing money when it's saved in a bank account. Or maybe you just like spending all your money and having all the nice things that you have. That could work as long as you're satisfied and if that is your goal. But if your goal is financial independence in the future, you need to realize that putting your money to work for you means there's some risk involved. But the risk is definitely worth the reward with a guaranteed growth of 10, 15, 20 years in the future. Myth number 4. The market is rigged, you need insider information to make any money in the market, or you need to know exactly when to time the market in order to make any money. The fact that some people believe this myth, that the system is rigged, that it's set up against a little guy, that he can't participate in the stock market, that just shows us that you have no hope of growing your wealth. You have no hope of trying to move forward. And that myth keeps a lot of people from ever investing their money. It keeps a lot of people from trusting that money can actually grow for you. And instead, they either spend it all, or they hide it under their mattress, or they buy some gold bars. Now, is the market always fair to everyone equally? Probably not. There's a lot of proof that there's politicians or people involved in policy making that can actually use that information in order to invest in the future. Is that fair? Maybe not. But are you blocked from making money in the stock market? No. Are you limited in somehow being able to invest or finding good investment opportunities? That is also a big no. If you go down the road of believing that the system is rigged, then there's no hope to make money in the market. Then there's no hope for you to make your money grow. But if you realize you don't have to know all the details that the insiders know, maybe that the owners of companies know, investing in the broad market as a whole, you will make money. Now, I won't suggest that our system is perfect. There are some inequalities that exist. There are people who do have insider information. Maybe they're policymakers and they're allowed to use that knowledge to invest in the future. But to suggest that the whole system is rigged is to say that the average person is unable to invest and grow their money. The truth is, the average person can easily pick stocks, invest in the stock market, and grow their money just like anybody else. Myth number 5, this one's a big one. The market is at new highs, therefore it's gonna crash. And I'm just gonna simply sit on the sidelines, wait till the market goes down a lot, then I'll invest a lot of my money. Or the sister myth to that is, the market is starting to crash, the market's starting to go down, there's a lot of scary things in the headlines. I'm just gonna sell everything out, wait till the market drops, and then I'll just buy in at a lower price. The market is always gonna have upswings and downswings. And the more fear in the market, the scarier the headlines. Maybe we're talking about inflation, possibly a war with Russia, or the Federal Reserve causing a recession. All those fears that people have, that's already priced into the market. And you thinking that you're magically gonna somehow sell right now and buy at a lower price, most often what happens is when you sell, the market may go down a little bit, but then it starts to go higher. And you're gonna think, well, when it goes lower, then I'll buy. But it never goes lower. When the COVID crash happened, the market bounced up about 30% before people started to buy back in. So you're missing out on a lot of movement. So trying to time the market, it rarely works, and it never works on a consistent basis. It's not timing the market, but time in the market that is most important. So instead of trying to wait till the market bottoms out and then you're gonna magically know exactly when to buy, just consistently buy in, forget about market timing, you will beat 95% of professionals. Just missing out a couple days over the last decade that were really good up days, if you bought in after them, you'd miss out on a huge chunk of wealth growth. Myth number 6, you have to hire a professional in order to grow your money. We talked about this a little bit, that the financial industry makes things seem super complicated, very, very difficult to understand, as if you have to hire a professional. There is a growing amount of evidence that even the most experienced professionals rarely beat the market as a whole. So just investing in index funds, you will have a better rate of return. Myth number 6, in order to make a lot of money in the stock market, you have to buy IPOs when they first come out. IPOs are initial public offerings of companies. That's the first time that they get listed on the stock exchange. For example, recently we had like Airbnb, Uber, some other popular companies that came onto the public market. A lot of people love to talk about the idea of buying Microsoft, buying Tesla, buying Amazon when it first comes out. If you would have bought $10,000 in Tesla when it first came out, you'd have over $4 million right now. But let's take a look at the average IPO result. Jeremy Siegel from the University of Pennsylvania did a huge study on IPOs and how well they perform in the stock market. After studying 9,000 stocks, Jeremy was able to see that they perform about 2 or 3% lower than the general market. So rather than trying to jump on the bandwagon of IPOs, it's better to invest in the long term. Not only do they underperform the market, but when IPOs are the biggest thing in headlines, when everybody's talking about them, those years tend to be even worse for IPOs. How many people invested into Tesla when it first came out? How many people invested into Amazon when it first came out? If you are one of them, I'd love to talk to you. But the reality is, very, very few people even know about these companies. Most companies that join the stock market from the beginning, or IPOs, they tend to underperform the market. So I would rather invest in the whole market than trying to figure out which IPO is gonna do better. Myth number 8, you must have blank in your portfolio to be successful. For example, you must have Bitcoin, or you must have Ethereum, or you must have Palantir, or you must have Amazon. All these must-haves have changed over the decades. And the moment somebody's pumping the stock, or it becomes so popular in the media, chances are that it has already overperformed the market, and now it's probably going to underperform the market. The ARK Portfolios of Technology Innovations by Cathie Wood, for example. After it's been overperforming the market for a good solid year and a half, people found out about it. Everybody was telling each other, you must have some ARK in your portfolio. So when everybody piled in, when it became the new thing that you must have in your portfolio, it crashed. Since the peak, Cathie Wood stock has underperformed the market, and it's actually down about 50% from last year. There are a million different ways to become a millionaire in the future. The best is find out a long-term plan, stick to that plan, and don't let other people dictate what should be or shouldn't be your plan or part of your plan in the future. The less you listen to others' opinion, the faster you'll get to your goal. Myth number 9. Gold is a must-have in any portfolio. I mean, it's gold, right? There's a lot of gold bugs out there that will just tell you that if inflation's high, buy gold. If stock market's crashing, buy gold. If there's uncertainty, buy gold. If there's geopolitical risk, buy gold. Always buy gold, that's their answer. But how well has gold done compared to the stock market? On average, gold has returned less than 4% per year. The stock market returns 10% per year. 10, 4%. I'll stick with the 10%. One interesting fact is when COVID hit, or when other scary times hit, not only stocks drop, but gold also drops, crypto drops, and even bonds drop. When COVID crash happened, all of those asset classes went down together. Now, some went down less than others, but they all went down. Gold didn't magically go up. Now, if you have a significant amount invested and you want to be diversified, having some gold exposure is good. But you have to realize, gold does not perform well compared to stocks. It is a good hedge for certain situations, but you have to be aware that gold by itself doesn't return much money. It helps preserve value at only very specific certain times in history. Myth number 10. If you have $1 million, you are good to go. You can retire, you don't have to work. The problem with that statement is $1 million is not what it used to be. I have a long time yet till my retirement, and by then $1 million will probably be worth similar to $250,000. So instead of sticking to a number like $1 million thinking that that's how you'll make it, figure out the 4% rule. All you have to do is figure out what are your expenses for the year, multiply it by 25, and that's how much you need to retire. For example, if your cost of living is $50,000 per year and you multiply that by 25, that's going to tell you that you need about $1,250,000 to retire. If you live in a very expensive area and your standard of living is $100,000, you will need $2.5 million in order to retire. So depending on what your expenses are is how much you'll need to be able to retire. That way you can take out 4% from that fund indefinitely and it won't go down in value. Investing myths are very common in our society. Now, you can try and blame the average person, but the reality is we don't learn this in schools, we don't learn this from our parents, and the average person doesn't really know which information to listen to and which not. What we have to do is educate ourselves. So start to learn about investing. Start to educate yourself about what it means to actually invest for yourself, how you can manage your own money. And those kind of basic skills will help you the most in order to set your own financial future. Not only is this misinformation bad, but a lot of these myths, they keep people from investing their money and growing their money for their future. The fact that you guys are watching videos like this, that means you're well ahead of the curve. You're already learning information about investing, so you're gonna go a lot farther than the average person. Thank you for supporting this channel. If you find this video helpful, give it a thumbs up, share it with a friend, and as always, I wanna show you guys my Roth IRA. It's been moving around quite a bit. Right now, the value is about $89,200. This year is gonna be pretty turbulent, pretty crazy for us investors. So having a plan, sticking to it, and not really following the news, that way we don't over panic or oversell, that will help us achieve our own goal. Even if the market goes down, that will be a great buying opportunity for myself. So thank you for spending your time with me. I appreciate it. Wish you guys well. Love you all. Artie out.